Welcome to another Tomo live stream. I'm Tomo, and tonight we're going to be talking about dollar cost averaging. I've done some videos, some beginner investor videos on how to invest in the Australian stock market. So we're moving on from that now, and we're talking a little bit about investment strategy, and specifically lump sum investing versus dollar cost averaging. That's what we'll be talking about tonight. This is targeted ideally, I would say, at beginner investors. Can be more experienced investors as well, but if you're new to investing, you're learning, you're starting that journey, then this video is ideal for you. Now quickly, make sure you read my disclaimer. I'm not a licensed financial advisor. This video is for education and entertainment purposes only. What I try to do is provide you with, the educational tools to help you be a better investor. That's the way I learned, by reading and watching videos and doing things like that. So that's what I'm trying to share with you tonight. So hopefully you enjoy this video. Dollar cost averaging. Let's get into it. So when we talk about dollar cost averaging, what's really important to talk about is the psychology of investing. That's the first thing to talk about. Now, this is just a regular chart, a stock chart going up. And unfortunately, the psychology of investing is as stock prices go up, as they tend to increase, people tend to buy the stock. Okay. And it's this idea like, they don't want to miss out. It's on a rally. It's on a run. Let's get in. That's the psychology of investing. And when the stock market is going down, people tend to panic. People tend to sell their stocks. And what you really want to do is actually the reverse of those two. So your return as an investor in the stock is made up of two components. The increase in that stock's value, okay, the capital growth, and the dividend. And so to maximize the potential for the increase in the stock value, part one of that return is by buying when the stock is really cheap. If you buy when the stock's really expensive, it could still go up a bit further, but you've got a smaller window for your returns. Whereas if you buy when the stock is really low, then you have a much bigger opportunity to make some money on the investment. Okay, so what you really want to do is kind of the opposite of the psychology of investing. Is you want to buy when stocks are really low, and you certainly don't want to buy as stocks are increasing. There's a really famous quote by Warren Buffett that goes, when everyone is panicking, i.e. when everyone's selling, that's the time to be greedy. And when everyone's being greedy, that's the time to be fearful. So that's a really good quote to learn. Now, it is really hard. First, let's see how the professionals do. Let's see how the professionals do when picking stocks, okay? This is a really good article. This is a well-known article, highly publicized. And this is by the Motley Fool. So in the last 15 years, 88% of professional investors, active investors, people that are reading the stock charts every day, reading financial statements, 88% of them were not able to beat the S&P 500 index. S&P 500 index is a common index in the United States. It tracks the top 500 companies in the US. So 88% of active investors were not able to beat the S&P 500 index over a 15-year period. Or said another way, if you had bought an ETF, an index fund that tracked the S&P 500, you would have done better. You would have outperformed 88% of professional investors. Let that sink in for a minute. That's pretty crazy. So what this article, I think, if you go a level deeper, what this article is actually saying is it is very, very difficult to pick the right time to buy a stock. Okay, is the stock price going up? Is it going down? Is it cheap? Is it not cheap? It is very, very difficult to determine that. That's what this article is saying. And that is where dollar cost averaging comes in. Okay, so what dollar cost averaging is, let's look at some of dollar cost averaging is. So first of all, let's talk about lump sum investing. So lump sum investing, you take lump sum, $1,000, $10,000, whatever it is. You invest it in a stock once, and that's your lump sum. Okay. What dollar cost averaging is instead of investing one lump sum, choosing an amount that is affordable to you, that you can invest in regular intervals. Could be weekly, could be monthly, could be fortnightly, something like that. Instead of investing a large sum of money up front, you invest smaller sums frequently and regularly. Okay. And by doing that, investing the same amount frequently and regularly, what you'll do is, this diagram shows it perfectly. As the stock price increases, you'll buy less of the stock. If it's more expensive, you can't buy as much. And as the stock price decreases, you will buy more, that's what we want, sort of going against the opposite of that psychology of investing. You want to buy more when the stock is cheaper. But it's very hard to determine why that is. So stock price averaging, dollar cost averaging, no matter if the stock is expensive, no matter if it's cheap, in regular intervals, you invest the same amount of money into the stock. And exchange traded funds can be a good way for beginner investors that just track an index. But that's what dollar cost averaging is. And what it's doing is essentially removing the emotional part of investing, removing that psychological part that makes you excited when the stock market gets up and tense or nervous when the stock market's going down. It removes that element from it. It limits the volatility. No matter if it's going up, if it's going down, if it's going sideways, you buy at regular intervals, and that's what dollar cost averaging does. It can be a really good strategy for beginner investors, something to really think about. Now, what are the returns under this approach? Now, it's very difficult to compare. First of all, I'll say, if you buy a really, really good stock at a cheap price, you're going to make great returns, okay? You may make far better returns than what you could under a dollar cost averaging method. The point of that is it's very difficult to do that. So for the average Joe, the average person, the average Joanne, this can be a good strategy that you can adopt. So it can be difficult to compare the returns that you could have got under a lump sum investment, because it really depends on what day you buy. Were you smart enough, or were you lucky enough to buy at the low and increase, or did you buy at the top and you didn't really receive that much in terms of returns under a lump sum approach versus dollar cost? So you can't really compare the two, but what we can compare, what we can look at, are some of the returns available under dollar cost investing. And they broadly mimic the returns of an index. So it could be an Australian, an ASX index, top 200 companies. It could be a US index, S&P 500. That's the kind of returns we're looking at for dollar cost investing. Dollar cost averaging, excuse me. So this is an example. This is an article by Vanguard. And this gives an example, in the Australian stock market over a 10-year period, had you invested, for example, $200 per fortnight, after 10 years, you would have amassed $72,000. And it goes up from there. If you're able to invest $450 a fortnight, which is quite a lot, after 10 years, it turns to $161,000. And that's on this idea that the Australian share market returns an average return of 8.3% over a 10-year period. 8.3%, it's nothing to laugh about. That's a decent return. There's obviously much better returns from that, but for someone who's just new to investing, or you want to do it in a bit more of a passive approach, 8.3% is not too bad. It's not something to laugh at all. Now, the next graph I want to put up is a graph that I really like. I've put it in a few of my videos right now. This is the return of the Australian stock market over a 124-year period. Okay. Now, looking at this, look how much green is on this chart. It really blows my mind. Now, there's obviously some really bad years. So 2008 on the far left, stock market went down 50%. That's pretty bad. But look at the overwhelming majority of green years, and look at the returns in those green years. So that tallest column is an average 10 to 20% return of those green years. So I love putting this up because it shows, and this is common for a lot of indexes, over a long period of time, having that long-term mindset in the stock market and tracking an index, you can get some fairly decent returns. This chart says that over a 124-year period, the average return in the ASX was 13%. In the Vanguard slide we saw before, the average return was 8% per annum. Okay, so with that long-term mindset and just an approach of so under dollar cost averaging, you're going to buy some in the red years. You're going to have some down years. You're going to have a lot of up years. That's the point. It's removing that volatility, removing that emotional decision making from the process, and it can be a really, really viable principle, a really good principle for beginners investors to consider. Okay. Really hope you enjoyed that. Have any questions, leave me a comment. If you use dollar cost averaging, leave me a comment, let me know. I'd love to hear from you. And I do a whole bunch of finance content ranging from teaching you how to invest in the stock market, how to save money on your mortgage, as well as other hot topics. So head over to my YouTube channel. There'll be some material that I guarantee that you'll enjoy. If you want to join the community, if you want to come on this journey with me, I'm relatively new to YouTube, consider subscribing and turning on that notification. Thanks for tuning in tonight. Stay safe.